Intangible assets are really the only lever that can move enterprise value beyond cash flow multiples. This is why these assets are critical when it comes to securing a higher valuation for your company. At EverEdge, we work with a lot of companies who are raising capital, ranging from startups through to large enterprise clients. In fact, our valuations have been instrumental in helping our clients raise over $1 billion in capital. Today, the key drivers of growth and profitability for virtually every company outside real estate are its intangible rather than its tangible assets. However, one of the frequent issues we see when companies try to raise capital is that investors dismiss their intangible assets as being irrelevant. This is completely incorrect for several reasons. First, the data shows quite clearly over 87% of company value today is driven by intangible assets. If you look at the tech sector, this number is even higher. Microsoft, Apple, Google, Facebook, and Amazon, interestingly, the world's top 5 companies by market cap, are approximately 98% intangible. If you look at most startups, basically they are entirely intangible. Their desks, chairs, and laptops aren't worth anything relative to their intangible assets. In addition, the quality of intangible assets a startup is generating via its research and development processes is a critical indicator for investors of future value, given the inherent lack of track record early-stage businesses have. Therefore, for investors to argue intangible assets are irrelevant or to ignore them in a valuation process is to completely fail to understand that today, intangible assets are the primary drivers of company value. Second, when we look at startups in particular, unfortunately, many founders don't do themselves any favors in the way they value their companies. A rookie error we often see from founders is setting a pre-money valuation along the following lines. We need to raise $2 million. We don't want to give away more than 33% of the company, so therefore we're worth $6 million. The problem with this approach is that it is essentially arbitrary. The valuation has been plucked out of thin air based not on what the company is actually worth, but on what the founders think it needs and how much the founders are prepared to give up, which more often than not is driven by emotion rather than fact. Neither of these two things is particularly correlated with the true value of the company itself. Further, being arbitrary, it allows and encourages investors to employ the same method and turn around and say, well, you need $2 million, I want 50% of your company, therefore you're worth $4 million. Right there, you've lost $2 million worth of value, and the thing is, both sides are equally wrong, but neither has a leg to stand on to prove it, as both numbers are arbitrary and both are based more on fiction than fact. Unfortunately, we see this approach taken all too often. Another approach we frequently see, especially with more mature companies, is entirely financially derived valuations. Investors or acquirers will look at forward-facing cash flows, run a discounted cash flow or DCF analysis, and reduce that back to a net present value. The problem with this methodology is that while discounted cash flow analysis works well for mature companies with stable and durable cash flows, they start to break down the moment a company is likely to pass through an inflection point. For example, if it plans to launch new products or technologies or move into new markets. In short, discounted cash flow valuations work well where the past is a good guide to the future. The problem, of course, is that most startups have no or little historical financial record, and for many growth-oriented businesses, the very businesses likely to be raising capital, the future won't look like the past. And hence, in both cases, discounted cash flows can quickly become unreliable. The response from many investors to the uncertainty of future cash flows in growth-oriented businesses is to whack a massive discount rate into the DCF to account for all the unknown risk, resulting in a reduced valuation for the company, which is, of course, quite convenient for the investor, but not so good for the company's owner or founders. So what to do? Well, if you want to secure a fair and accurate valuation for your business, and want a number that you can defend and justify to your investors, the better approach is to, number one, stay away from arbitrary valuations because they are just that, arbitrary. Number two, by all means, run forward-facing cash flows and build those models into your valuation, but make sure you also emphasize to investors that this is at best only one perspective on the value of the business. The real value of the business almost certainly lies in its intangible assets and their potential to generate both future value and their value to acquirers in the long term. For a prime example of this, take Instagram. At the time of Instagram's sale to Facebook, the company was 20 months old, employed 12 people, had effectively no assets on its balance sheet, had no revenue, and most importantly, had no sight line to any future revenue either. A traditional discounted cash flow analysis would have told you that Instagram was worth $0, yet it was sold to Facebook for $1 billion. Now, some people might argue, well, maybe Facebook overpaid for Instagram. But that is clearly not the case, and we know this for a couple of different reasons. Number one, external research shows that Facebook has made at least 6 times its money on the purchase of Instagram. Secondly, fast forward to today, and Bloomberg Intelligence estimates that Instagram would be worth more than $100 billion if it were its own company and not a Facebook division. So we know Zuckerberg didn't overpay. If anything, he underpaid. The real explanation is that Facebook acquired Instagram not for 12 employees, or its laptop and chairs, or its non-existent cash flow, but for its intangible assets, its brand, its data, and its fast-growing user base. Instagram's value, like most startups and growth-oriented companies, was in its intangible assets. It's just that conventional company valuation approaches would have largely ignored these assets and their value. In summary, if you are looking to raise capital, the best way to manage investors is to be upfront and frank about where your value is. Don't get dragged into arbitrary valuations. Avoid getting too focused on cash flows, and talk instead about the value of the intangible assets your company is building and why and to whom these assets are ultimately going to be valuable. This will help you create a robust, defensible valuation that more accurately demonstrates the future value of your business.